In the shadow of headlines about artificial intelligence breakthroughs and climate catastrophes, a silent war has been waging across the globe. A war for one of humanity's oldest treasures. Silver, the lustrous metal that has shaped empires since antiquity, is being quietly accumulated at unprecedented rates by two seemingly unrelated forces: the Chinese government and a growing global community of preppers preparing for societal breakdown. As dawn breaks over a remote warehouse in Anhui province, workers carefully unload pallets of 1,000-ounce silver bars from an unmarked truck. 8,000 miles away, in a suburban American basement, a software engineer carefully arranges silver coins in a fireproof safe hidden behind a false wall. These scenes, playing out daily across the world, are symptoms of a profound shift in how we value this precious metal in our increasingly unstable world. This is not a coincidence. It is a convergence, the result of ancient wisdom meeting. Modern fears of individual survival instincts aligning with national strategic interests. To understand why both preppers and the world's second-largest economy are stockpiling the same asset requires us to journey through history, economics, and the darkest corners of our collective anxieties about the future. To understand silver's modern magnetism, we must first appreciate its historical gravity. Unlike gold, which primarily served as wealth storage, silver has always been the working metal of empires, facilitating trade, financing wars, and enabling technological advancement. In 600 BCE, when the Kingdom of Lydia introduced the world's first standardized metal currency, they chose an alloy of gold and silver called electrum. But it was pure silver that would become the backbone of monetary systems for the next 2 millennia. The ancient Greeks mined silver from the Laurian mines to finance their golden age of democracy and philosophy. The Roman denarius, a small silver coin, powered the greatest empire the Western world had ever seen until debasement of its silver content coincided with Rome's decline. But nowhere was silver's power more evident than in the Spanish conquest of the Americas. When the Spaniards discovered the mountain of silver at Potosi in modern-day Bolivia in 1545, they unleashed the greatest transfer of wealth the world had ever seen. Between 1500 and 1800, over 85% of the world's silver production came from Spanish America, with much of it flowing to China in exchange for silk, porcelain, and tea. The mountain that eats men, as Potosi became known for its brutal working conditions, fundamentally altered the global economy. Spain became temporarily wealthy but suffered long-term inflation that contributed to its decline. Meanwhile, China's economy expanded dramatically with the silver influx, only to contract painfully when that supply later diminished. This pattern, silver's flow dictating economic destinies, would repeat throughout history. By the 19th century, most major economies operated on some form of silver or bimetallic standard. The U.S. Coinage Act of 1792 established a silver-to-gold ratio of 15:1, with both metals backing the currency. Similar systems prevailed across Europe and Asia. China, however, maintained a pure silver standard long after Western nations had moved away from it. The Qing dynasty's finances were entirely silver-based until the early 20th century. This dependence on silver made China vulnerable to external manipulation, most notably during the Opium Wars, when British traders deliberately drained China of its silver reserves to correct their trade imbalance. The global abandonment of silver standards accelerated after the discovery of massive silver deposits in Nevada's Comstock Lode in the 1870s, which drove down silver prices relative to gold. By 1900, most major economies had shifted to gold standards, relegating silver to secondary monetary status. The final death knell for silver's monetary role in the United States came in 1964, when the government stopped minting 90% silver coins for circulation. A decade later, Americans were legally permitted to own gold again after a 40-year prohibition, further cementing gold's status as the premier monetary metal in Western consciousness. Yet silver's monetary heritage never completely faded from memory. Those who studied history recognized a pattern. Civilizations rise with sound money and fall when their currency is debased. This lesson would become increasingly relevant as the 21st century unfolded. China's relationship with silver is particularly complex and deeply rooted in its imperial history. For centuries, China operated a dual currency system with copper coins for everyday transactions and silver for large payments and tax collection. Unlike European powers who tied their currencies to fixed weights of precious metals, China used silver by weight rather than by coin. The Spanish silver dollar, pieces of 8, became so integral to China's economy that it continued circulating there long after Spain's empire faded. The Mexican silver peso, modeled after the Spanish dollar, remained legal tender in parts of China until the 1930s, a testament to silver's enduring role in Chinese commerce. This historical memory has not been lost on modern Chinese leadership. As a civilization with 5,000 years of continuous history, China's economic planners take a much longer view than their Western counterparts who focus on quarterly earnings and election cycles. They remember how silver flows shaped dynasties and how foreign powers once exploited China's silver-based economy. Today, as China positions itself as a challenger to American hegemony, these historical lessons inform its approach to monetary metals. The past isn't just prologue, it's strategic guidance. The modern prepper movement emerged from the convergence of several Cold War-era subcultures. Survivalists concerned about nuclear war, back-to-the-land enthusiasts seeking self-sufficiency, and religious groups preparing for apocalyptic prophecies. But what was once a fringe phenomenon has expanded dramatically in the 21st century, accelerated by a series of shocking events that undermined public faith in institutional stability. The September 11th attacks in 2001 first cracked America's sense of invulnerability. Then came the 2008 financial crisis, revealing the fragility of our banking system. Hurricane Katrina exposed the limitations of government disaster response. The COVID-19 pandemic shattered supply chains and introduced millions to empty store shelves for the first time. Most recently, the regional banking crisis of 2023, the Israel-Hamas war, and escalating climate disasters have continued to normalize preparedness. What defines today's prepper is not ideology but pragmatism, a clear-eyed assessment that complex systems can and do fail. Modern preppers include Silicon Valley executives, medical professionals, and financial analysts alongside the stereotypical rural survivalists. They're united not by paranoia but by a desire for resilience in an increasingly unpredictable world. And central to many preppers' strategy is silver. Why preppers choose silver? While gold has always been the premier wealth preservation asset, silver offers preppers several unique advantages that make it particularly attractive for collapse scenarios. 1. Divisibility and affordability. Unlike gold, which is too valuable for small transactions in a crisis, silver's lower price per ounce makes it practical for everyday commerce if traditional currency fails. A single 1-ounce gold coin might be worth a month's food, difficult to divide for smaller purchases. Silver's lower unit value makes it more practical. 2. Industrial utility. Beyond its monetary properties, silver has thousands of industrial applications from water purification to antibacterial treatments. In a long-term crisis, this practical utility provides a floor for silver's value independent of its monetary role. 3. Historical precedent. During every major currency collapse of the 20th century, from Weimar Germany to Zimbabwe to Venezuela, precious metals reasserted their monetary role. Silver coins, already familiar in size and weight, became natural currency substitutes. 4. Anonymity. Unlike digital assets or bank accounts, physical silver changes hands without surveillance. In a world of increasing digital control, this privacy is valuable to those concerned about government overreach. 5. EMP resistance. Unlike cryptocurrency or electronic banking, silver requires no functioning electrical grid or internet to retain value. This makes it resistant to electromagnetic pulse (EMP) attacks or solar flares that could disable electronic systems. Silver is poor man's gold with a PhD in engineering, says James Anderson, a veteran precious metals analyst. It's simultaneously money and technology, making it uniquely positioned for both wealth preservation and post-crisis utility. The prepper case for silver was articulated most influentially by financial commentator Mike Maloney in his series Hidden Secrets of Money, which has garnered tens of millions of views since 2013. Maloney argued that modern fiat currency systems invariably end in hyperinflation or default, making precious metals essential insurance against systemic collapse. But perhaps the most compelling reason for preppers' attraction to silver lies in the relationship between the metal's supply and its price, a relationship that has grown increasingly strained. The Great Silver Anomaly. For most of human history, silver was more plentiful than gold, with the Earth's crust containing approximately 17 to 20 times more silver than gold. This natural ratio is reflected in historical silver-to-gold price ratios, which averaged about 15 to 1 for centuries. But something strange happened in the modern era. Despite silver's critical industrial uses, its price relative to gold collapsed, reaching ratios as extreme as 125 to 1 in 2020. This occurred even as above-ground stockpiles of silver dwindled due to industrial consumption. Unlike gold, which is almost never destroyed, an estimated 98% of all gold ever mined is still in circulation, silver is consumed industrially in such tiny amounts per application that recovery is often uneconomical. Photography once used vast quantities of silver, and though digital technology has reduced this demand, new applications in electronics, solar panels, and medical products have more than compensated. This creates what some analysts call the silver paradox. The more essential silver becomes to modern technology, the more it's treated as an industrial metal rather than a precious one, despite its increasing scarcity. For preppers, this price anomaly represents both opportunity and confirmation. The opportunity: acquiring an undervalued monetary metal at industrial metal prices. The confirmation: that markets can remain irrational far longer than expected, validating their skepticism about financial system efficiency. As one prominent prepper blogger wrote, "When the music stops, the true value of physical silver in hand versus paper promises will suddenly become very clear." By 2025, this view had spread far beyond traditional prepper communities, with even mainstream financial commentators questioning silver's prolonged undervaluation relative to its supply fundamentals. The stage was set for a dramatic revaluation, one that China appears to have anticipated. While Western preppers have been accumulating silver one coin at a time, China has been executing a national strategy measured in thousands of tons. Understanding this strategy requires appreciating how differently China views economic security compared to Western nations. Since the 2008 financial crisis revealed the vulnerabilities of the dollar-based financial system, China has systematically increased its gold reserves while carefully obscuring its activities in the silver market. Official gold reserves have quintupled since 2000, reaching over 2,000 tons by 2026, though many analysts suspect the true figure is significantly higher. China's approach to silver has been even more opaque. Unlike gold, for which central bank holdings are regularly reported to the IMF, there is no international reporting requirement for national silver reserves. This has allowed China to accumulate silver with minimal market disruption or international scrutiny. Evidence of this accumulation comes from multiple sources. China has been the world's largest silver producer for over a decade, yet virtually none of this production leaves the country. Instead, China continues to be a net importer of silver, with imports exceeding officially reported industrial consumption. In 2025, China's State Reserve Bureau, SRB, began acquiring silver directly from domestic miners at above-market prices, bypassing international markets entirely. By 2026, China had implemented export controls on silver, requiring government licenses and imposing minimum production thresholds that effectively consolidated export privileges among state-aligned entities. These actions mirror China's previous strategy with rare earth metals, where it leveraged its dominant position to influence global markets and secure strategic advantages. With China controlling 60 to 70% of global silver refining capacity, the implications for the international silver market are profound. China's silver strategy serves both geopolitical and industrial objectives, making it particularly valuable from Beijing's perspective. Geopolitically, accumulating monetary metals provides China a hedge against dollar hegemony. As U.S.-China tensions have escalated, Chinese officials have repeatedly expressed concern about potential financial sanctions, similar to those imposed on Russia following its invasion of Ukraine. Physical silver and gold, unlike dollar reserves, cannot be frozen with a keystroke. Industrially, silver is critical to China's technology leadership ambitions. As the world's leading manufacturer of solar panels, electronics, and electrical vehicles, China requires enormous quantities of silver. Solar photovoltaic production alone accounts for 20% of global silver consumption, with China dominating manufacturing in this sector. Perhaps most significantly, silver is essential to China's semiconductor ambitions. The Made in China 2025 initiative specifically targets semiconductor self-sufficiency as a national priority, and advanced chip manufacturing requires high-purity silver, as the U.S. has tightened semiconductor export restrictions. Securing the raw materials for domestic production has become increasingly important. China's approach to silver is consistent with their broader strategic minerals policy, explains Dr. Zhang Wei, an economist specializing in China's resource strategy. They identify critical materials, secure supply chains, build stockpiles, and then use their market position to advantage domestic industries while creating leverage over foreign competitors. This approach becomes particularly significant when we consider the current state of the global silver market. By 2025, the structural imbalance in silver supply and demand had reached critical levels. Global demand reached 1.24 billion ounces, while supply lagged at 1.01 billion ounces, creating a 230 million ounce shortfall. This deficit marked the fifth consecutive year of silver market imbalance. 1. Mining constraints. Primary silver mines, where silver is the main product rather than a byproduct of other metal mining, had been declining for years due to underinvestment. With 70% of silver production coming as a byproduct of copper, lead, and zinc mining, supply couldn't quickly respond to higher silver prices. 2. Green energy demand. Solar panel production consumed over 140 million ounces annually by 2025, a figure projected to grow as global decarbonization accelerated. 3. Industrial expansion. Electronics, medical applications, and water purification systems continued to increase their silver consumption, with limited price sensitivity due to the small amount required per device. 4. Investment demand. As inflation concerns persisted following unprecedented monetary expansion during the COVID-19 era, investor demand for physical silver surged, competing directly with industrial users. The consequences of this deficit became increasingly visible in the physical market. COMEX warehouse stocks declined by 70% from their 2020 levels. The Shanghai Gold Exchange's silver inventories reached 10-year lows. Most tellingly, regional price disparities emerged, with premiums in Asian markets significantly exceeding Western spot prices, a classic symptom of physical tightness. By late 2025, these strains culminated in silver reaching $78.65 per ounce, representing a 150% increase for the year and a quadrupling from its 2020 levels. Yet even this dramatic rise merely brought silver back to its 1980 nominal high, still well below its inflation-adjusted peak. For China, which had been accumulating silver throughout this period, the price increase represented both validation of its strategy and an opportunity to leverage its position. The most visible manifestation of China's silver strategy came in April 2025 with the launch of the Shanghai International Silver Exchange, SISE. Building on the infrastructure of the Shanghai Gold Exchange, SISE introduced silver contracts denominated in yuan and backed by physical metal, with a crucial difference from Western exchanges. While COMEX silver futures in New York required only 5,000 ounces for delivery, SISE set minimum delivery at 25,000 ounces, explicitly targeting industrial users and institutional investors rather than speculators. Most significantly, SISE contracts specified physical settlement as the default, rather than the cash settlement common in Western markets. Shanghai is creating a physical premium market, explained veteran precious metals analyst David Morgan. By emphasizing delivery over cash settlement, they're drawing a distinction between paper silver and physical metal, a distinction that becomes critical in tight markets. Within 6 months of its launch, SISE was handling over 35% of global silver trade, with its prices consistently trading at a premium to London and New York. This premium reflected two realities: the increasing physical scarcity of silver and China's willingness to pay for guaranteed access. For industrial users outside China, the emergence of Shanghai as a price-setting venue created a troubling dynamic. They now face competition not just from investors and other industries, but from a strategic national stockpiling program with potentially limitless resources. By January 2026, China's new export controls completed the picture. By restricting silver exports while continuing to import aggressively, China effectively positioned itself as the silver market's central bank, able to influence global prices through its buying patterns while insulating its domestic industries from the highest prices. For preppers watching these developments, China's actions served as powerful confirmation of their thesis. If the world's most forward-thinking economic planner was hoarding silver, perhaps their own concerns weren't so far-fetched after all. What makes the parallel accumulation strategies of Chinese planners and Western preppers particularly fascinating is the information asymmetry between them. China's government has access to comprehensive global supply chain data, geological surveys, and industrial consumption patterns that individual preppers can only estimate. Preppers, meanwhile, often possess historical knowledge about currency collapses and societal disruptions that may not factor into formal Chinese planning documents. Yet despite these different information sets, both have arrived at the same conclusion: physical silver is undervalued and likely to become more scarce. This convergence is partially explained by silver's unique dual nature as both an industrial necessity and a monetary asset. Most commodities fall clearly into one category or the other. Oil is critical to industry, but makes poor money. Gold is excellent money, but has limited industrial applications. Silver straddles both worlds, essential to modern technology while carrying a 5,000-year history as a monetary metal. What we're seeing is two different types of actors recognizing the same fundamental reality from different angles, explains economic historian Peter Sullivan. The prepper sees silver through the lens of monetary history and worries about currency collapse. The Chinese planner sees it through the lens of industrial necessity and supply chain security. Both recognize its scarcity value is likely to increase. This dual perspective creates a powerful pincer movement on available silver supplies. Industrial users must have silver regardless of price for production processes. Monetary demand, meanwhile, often accelerates precisely when economic uncertainty increases, creating the potential for self-reinforcing demand spikes. History offers numerous examples of how dual-use commodities perform during economic crises, and the lessons are instructive for understanding silver's potential trajectory. During the hyperinflation of Weimar Germany in 1922 to 1923, industrial commodities initially outperformed pure monetary assets as Germans sought anything tangible to preserve purchasing power. A similar pattern emerged during the 2001 to 2002 Argentina crisis, when fuel, food, and industrial materials commanded tremendous premiums over their normal values. In both cases, items with practical utility maintain their value better than pure financial assets. This utility premium becomes particularly significant during transitions from currency crisis to recovery, when production must restart but financial systems remain impaired. Silver's position in this spectrum is uniquely powerful. Unlike food or fuel, it doesn't spoil or require specialized storage. Unlike industrial metals like copper or zinc, it has immediate recognition value and divisibility. And unlike gold, its lower unit value makes it practical for everyday transactions. The closest historical parallel might be the price behavior of palladium during Russia's 1998 financial crisis. As Russia's primary palladium producer faced export difficulties during the country's financial turmoil, the metal's price tripled within 18 months, despite a global economic slowdown, driven by industrial users stockpiling to ensure production continuity. For silver, with its much broader industrial applications and monetary history, the potential pressure from similar dynamics could be substantially greater. Perhaps the most intriguing aspect of the East-West silver accumulation story is the emerging feedback loop between prepper narratives and Chinese policy decisions. As China's silver stockpiling became more evident through import statistics and policy announcements, prepper-oriented financial commentators incorporated this information into their analyses. These analyses, in turn, influenced a wider audience of investors and industrial users who began their own precautionary stockpiling, further tightening the physical market. By early 2026, what began as separate phenomena had merged into a coherent market narrative about structural silver scarcity. Mainstream financial publications that had long dismissed silver bugs as doom-mongers began publishing serious analyses of supply constraints and strategic hoarding. Industrial users who had previously operated with just-in-time inventory practices began extending their stockpiling horizons from months to years. This narrative convergence created precisely the market conditions both preppers and Chinese planners had anticipated: physical premiums expanding, delivery delays lengthening, and above-ground inventories declining despite rising prices. We're witnessing the early stages of what monetary historians call the scramble phase, noted one prominent hedge fund manager in a widely circulated client letter. When confidence in future supply availability erodes, price becomes secondary to acquisition. For industries dependent on silver, the implications of this squeeze are profound and potentially disruptive. Solar panel manufacturers, who require approximately 0.2 ounces of silver per panel, have already seen silver rise from 5% of their production costs to nearly 14% as of early 2026. Most concerning for these manufacturers, silver has proven extremely difficult to substitute without performance losses. Electronic manufacturers face similar challenges. While the quantity of silver per device is minimal, the aggregate demand across billions of consumer electronics creates substantial exposure to price increases. More critically, production lines configured for silver-based components cannot be quickly retooled for alternatives. The semiconductor industry, perhaps the most strategically important silver consumer, faces particular vulnerabilities. Advanced chip manufacturing requires 99.999% pure silver for critical processes, a grade that becomes increasingly difficult to source reliably in tight markets. These industrial realities create the potential for supply chain cascades, where silver scarcity disrupts production across multiple sectors simultaneously. Such disruptions would likely prioritize the highest value applications first, potentially accelerating substitution in less critical uses, a process that paradoxically could make truly essential silver applications even more valuable. For China, with its established stockpiles, these dynamics represent both economic opportunity and competitive advantage. Chinese manufacturers with guaranteed silver access could continue production while competitors struggle with supply uncertainties and higher costs. Beyond its industrial implications, the silver squeeze has reignited discussion about silver's monetary role in a way not seen since the Hunt brothers' famous corner attempt in 1980. As double-digit inflation persisted in Western economies following the pandemic spending spree, public interest in inflation hedges expanded beyond traditional financial assets. Central banks' persistent balance sheet expansions undermined confidence in fiat currency stability, while growing government debt levels raised concerns about future monetization. Against this backdrop, silver's historical monetary role began to reassert itself in popular consciousness. Online communities dedicated to silver investing exploded in popularity, with the Reddit forum r/Wall Street Silver growing from 250,000 members in 2023 to over 1.5 million by early 2026. What began as a niche prepper concern had evolved into a mainstream investment narrative. This monetary demand layer created a unique market dynamic where silver was simultaneously experiencing industrial demand growth, investment demand growth, and strategic national stockpiling, a triple demand driver with no historical precedent. For preppers who had accumulated silver over the preceding decade, this mainstream recognition brought both vindication and practical challenges. Their foresight was rewarded with substantial appreciation, but their ability to continue accumulating at reasonable prices diminished as premiums expanded. For China, the re-emergence of silver's monetary premium aligned with its longer-term ambitions for a post-dollar international monetary system. By controlling a significant portion of the world's physical silver, China positioned itself advantageously for any future monetary reset involving precious metals. The most far-reaching implications of the silver squeeze may be geopolitical. As industrial users outside China faced increasing difficulty securing stable supply chains, the potential for government intervention grew. The U.S. Strategic Metals Reserve, established in 2024, primarily focused on lithium, cobalt, and rare earth elements, expanded its mandate in early 2026 to include silver as a critical strategic metal. Japan and South Korea, both heavily dependent on silver for their electronics industries, announced similar national stockpiling programs. These governmental actions marked a significant shift in how silver was officially categorized, from a market commodity to a strategic resource subject to national security considerations. This reclassification carried profound implications for mining regulation, export controls, and international trade agreements. For preppers, this geopolitical dimension added a new concern to their calculus. While they had long worried about currency collapse or financial system failure, the prospect of governments restricting private ownership of strategic metals introduced an additional risk factor. Historical precedent existed in the form of the 1934 Silver Purchase Act, which had nationalized privately held silver in the United States at a fixed price. For China, the growing recognition of silver's strategic importance by other nations validated its early mover advantage. By the time Western governments began formulating coherent silver policies, China had already secured substantial physical inventories and established dominance in the physical delivery market. This asymmetry created the potential for silver to become another front in the broader economic competition between China and the West, a competition increasingly focused on resource security and supply chain resilience. Looking forward from 2026, the fundamental supply-demand imbalance in silver appears likely to persist and potentially accelerate. Several factors contribute to this trajectory. 1. Mining pipeline constraints. Despite higher prices, the development timeline for new primary silver mines remains 7 to 10 years from discovery to production. Existing mines face declining ore grades, with the global average falling from 500 grams per ton in 1900 to under 150 grams by 2025. 2. Green energy commitments. Global solar capacity is projected to triple by 2035, with corresponding silver demand growing from 140 million ounces annually to potentially over 300 million ounces, nearly 30% of current total production. 3. Electromagnetic warfare preparations. As geopolitical tensions escalate, military applications for silver, particularly in electromagnetic shielding, are experiencing rapid growth, adding another source of inelastic demand. 4. Financial system fragility. Persistent inflation, growing sovereign debt, and increasing central bank interventions continue to drive investor interest in tangible alternatives to fiat currency and electronic assets. These factors suggest that even with substantially higher prices, the physical silver market will likely remain under pressure for years to come. The primary relief valve, substitution in less critical applications, requires both time and technological adaptation, neither of which can be quickly implemented across diverse industries. For preppers who secured their desired allocations before the dramatic price increases, this trajectory confirms their strategic foresight. For those still accumulating, the challenge becomes identifying entry points in an increasingly volatile market while avoiding potential government restrictions on acquisition. For China, the long-term scarcity trajectory reinforces the value of its established stockpile while potentially providing leverage over competitors dependent on reliable silver access. By controlling both significant physical inventory and the majority of refining capacity, China has positioned itself as the indispensable partner for industries requiring guaranteed silver supply. As we look beyond the immediate dynamics of the silver squeeze, a new paradigm for understanding silver appears to be emerging, one that transcends the traditional categories of industrial commodity or monetary metal. In this emerging framework, silver is best understood as a strategic technology enabler, essential to the key innovations driving the 21st century economy, from renewable energy to artificial intelligence hardware to advanced medical applications. This reclassification places silver alongside other critical materials like lithium, cobalt, and rare earth elements as foundations of modern technological civilization. Simultaneously, silver's monetary history and physical characteristics position it uniquely among these strategic materials as a potential bridge between the fiat currency system and whatever monetary arrangements might succeed it. Unlike purely industrial metals, silver carries 5,000 years of monetary recognition, a characteristic that becomes increasingly valuable during periods of monetary uncertainty. This dual nature, strategic industrial necessity and historical monetary asset, creates a foundation for silver's role in the coming decades that differs substantially from its position in the 20th century. For preppers, this evolving paradigm validates their intuition about silver's unique properties, while suggesting that its value trajectory may be influenced by factors beyond their traditional focus on monetary collapse scenarios. The prepper case for silver expands from purely monetary insurance to include supply chain resilience and technological self-sufficiency. For China, the new silver paradigm aligns perfectly with its broader strategic objectives: securing critical supply chains, developing technological independence, and preparing for potential changes to the international monetary system. By recognizing silver's strategic importance early and acting decisively, China has secured advantages that will be difficult for competitors to overcome. For individuals watching these developments unfold, the question of whether to accumulate physical silver remains highly personal, influenced by financial circumstances, risk assessment, and broader preparedness philosophy. The case for personal silver accumulation rests on several factors. 1. Insurance value. Even a modest silver allocation provides tangible insurance against extreme financial system disruptions at a relatively low carrying cost. 2. Asymmetric returns potential. The structural supply deficit combined with silver's dual demand drivers creates the potential for outsized returns if industrial shortages trigger broader monetary recognition. 3. Strategic alignment. Following the example of forward-thinking entities like the Chinese government can provide individual investors with strategic advantages similar to those sought by national planners, albeit on a smaller scale. 4. Historical precedent. Throughout history, individuals who preserved wealth in tangible assets during monetary transitions have consistently maintained purchasing power better than those relying exclusively on the prevailing currency system. The case against personal silver accumulation includes 1. Storage and security concerns. Physical metals require secure storage, creating either carrying costs for professional vaulting or security risks for home storage. 2. Liquidity constraints. In normal market conditions, physical silver carries bid-ask spreads significantly wider than financial assets, potentially reducing effectiveness for short-term liquidity needs. 3. Confiscation. Risk. As silver's strategic importance increases, the possibility of government restrictions on private ownership similar to the 1934 Silver Purchase Act cannot be dismissed. 4. Opportunity cost. Capital allocated to physical silver is unavailable for potentially productive investments in businesses, skills development, or other preparedness priorities. Balancing these considerations requires each individual to assess their personal risk profile, financial objectives, and broader preparedness strategy. There is no one-size-fits-all answer. What seems increasingly clear, however, is that silver's role in the global economy is undergoing a significant transformation, one that merits attention regardless of whether one chooses to personally accumulate the metal. As we conclude our exploration of why preppers in China are hoarding silver, we return to the historical perspective with which we began. Silver has flowed through human civilization like a shimmering thread, connecting economies, enabling technological advancement, and preserving wealth through centuries of turmoil. What makes the current chapter in silver's story particularly compelling is the convergence of ancient wisdom and modern necessity, the recognition by both forward-thinking individuals and the world's oldest continuous civilization that this particular element carries unique value in an uncertain future. In the prepper's basement and in China's strategic reserve vaults, silver bars and coins sit quietly, physical embodiments of a hedge against uncertainty. Though acquired for different immediate purposes, they represent the same fundamental insight, that certain tangible realities endure even as financial systems and geopolitical arrangements evolve. Whether silver's next chapter involves dramatic price appreciation, Strategic resource competition or a return to monetary prominence remains to be seen. What seems increasingly certain is that this ancient metal will continue to play a vital role in shaping our collective future, just as it has for the past 5 millennia. For those paying attention to silver's unfolding story, the lesson might be that sometimes the most valuable insights come not from the latest financial innovation or technological breakthrough, but from recognizing the enduring patterns that have shaped human civilization throughout recorded history. In silver's gleaming surface, both preppers and Chinese strategists see reflections of a future where tangible realities matter more than financial abstractions, a vision that grows more compelling with each passing day of global uncertainty.